Hi, welcome back to this course on infrastructure finance. Today in lecture 7 we are going to talk about analyzing the company's performance. So far in the earlier lectures we have talked about how do we actually look at the company's financial statements and what kind of information do we find in these financial statements, and taking on from there today we will talk about how we can use the information in the financial statements and analyze the company's performance. But before that, let us get back to the thought questions that we put forward in the previous lecture. So question 1 was, if the company delays making payments to its suppliers, how would the financial statements be affected? So we will try and discuss this question, but before that let us try and get a bird's eye view of the entire financial statements that we have discussed so far. So we have looked at three types of financial statements: the profit and loss account, and then we had the balance sheet, and then we had the cash flow statement. So in the profit and loss account we broadly looked at the revenues, and then the company had expenditures in producing these revenues, and then we had what is called as your operating margin, then the company incurred additional expenditures towards general administration, so this gives what is called as your profit before interest and tax. If the company has borrowed certain amount of capital, it will have to pay an interest, and net of interest we have profit before tax, and a profit making company has to pay tax to the government, then we have tax, then we have profit after tax. So this is the general overall scheme of a profit and loss account. Now let us look at your balance sheet. Balance sheet, if you remember, it has two components. One is we have the source of funds, this is also called as liabilities, and then we have uses of funds. This is also called as your assets. Now liabilities can be classified into two forms. One is your long term liabilities, and you have short term liabilities. So long term liabilities we have what is called as your equity, and then you have your long term debt. Short term liabilities are essentially what is called as your current liabilities. Current liabilities contain various items, the principal among them being accounts payables. Similarly, if you look at your assets, assets can be classified into two categories. One is your fixed assets or long term assets, and then you have your short term assets or current assets. So fixed assets would involve items like equipment, any asset that is actually going to give benefits for a long duration of time will come under fixed assets. In current assets we have items like accounts receivable, we would have cash, and then we would have inventory. Next we will come to the cash flow statement. So cash flow statement, we will look at cash flows from three different sources. One is your cash flow from operating sources, and then you have cash flow from financing activities, and then you have cash flow from investment activities. Now let us go back to the question. So the question is, if a company delays making payments to its suppliers, how would the financial statements be affected? So we have now three sets of financial statements. The first task for us now to look at accounts payable is reflected in which of the statement. So if you look at the three statements, and when you look at the balance sheet, accounts payable is coming under your short term liabilities. Now the question is, if the company is delaying making payments to its suppliers, how would the financial statements be affected? So if the company is delaying payments, there would be a high amount of accounts payable. When the company makes a payment to its suppliers, then account payables gets reduced, and if the company is delaying payments, the account payable get increased. So if the account payable increases, then what could be the various impact that it would have on the financial statements? Now we should look at the financial statement as just not three independent statements, but there is a strong interlinkage between all the three statements. For example, if there is an increase in accounts payable, then the first indication that you will have is what is called as your net working capital. Net working capital is nothing but your current assets minus your current liabilities. Now if the accounts payable is going to increase, that means the current liabilities will also increase. Now if the current liabilities increase, then what is actually going to happen to the net working capital? The net working capital is going to reduce. So the very act of the company trying to delay payments to the suppliers is in a way going to reduce the net working capital requirements of the company. The company does not need to have a large amount of resources getting tied up in working capital. Now if the net working capital reduces, what is going to happen to the cash flows? Now in the cash flows we have three different statements, three different parts. Net working capital would be reflected in which of the parts? So if you recollect our discussion on cash flow statement, you will remember that net working capital will be featured under the cash flow from operations. Now if there is a reduction in net working capital requirements, then it is also going to have a corresponding effect in the cash flow on operations. An increase in net working capital means a need for more cash is treated as a cash outflow. A decrease in net working capital is treated as similar to that of a cash inflow. So therefore a decrease in net working capital in some sense is actually going to increase the cash flow from operations. So now to summarize, if there is a delay in making payments to the suppliers, then the first impact is the net working capital will reduce, and because of the reduction in net working capital, the cash flows from operating sources is going to have an increasing effect. So any change in any of the components of each of these financial statements is going to be interlinked, and it is going to actually have a corresponding effect over many of the items. We will now go to the next question. The next question is, how can we use the information in financial statements to analyze the performance of the companies? In fact, the crux of the lecture today and the next is going to be, how do we elicit information that we have in the financial statements and use that information to analyze, to make a judgment on the company's performance. So, the main question now is to look at how do we really judge a company's performance. When you are looking at an organization actually has several facets, and when you want to talk about performance, we will have to really look at performance on which of the facets. It is going to be very difficult to say this is one indicator that reflects the entire performance of the company, whereas we have several indicators looking at each and every aspect of the performance of the company. So, let us talk about some of the main parameters of performance that we normally use. The first parameter is a growth parameter. A growth parameter indicates how much the company has grown. So, we can really look at growth in terms of revenues, we can look at growth in terms of profits, we can look at growth in terms of asset size, or whatever parameter we are interested in. So, it is very important for a business to grow, and understanding and tracking the growth of the company indicates several things about the company's performance. The next parameter of the company's performance is profitability. Profitability is an indication of how much profit the company is making. Similarly, we have other measures of performance such as liquidity, leverage, turnover, or valuation. So, what we will do is we will try and look at these main parameters of company's performance in this lecture and the subsequent lecture. First, let us look at growth. It is very important for a business to grow. Growth in the business indicates that the future is very bright and the company is going to be viable, the company is going to sustain its operations for a long period of time. Let us look at a simple example of growth. Let us talk about revenue growth to start with, and we will always go back to the example of a National Thermal Power Corporation's balance sheet that we have used in the previous lectures to understand these various parameters that we are talking about. So, if we talk about revenue growth, we will have to really understand how the revenue has grown vis-a-vis the past. So, revenues could be obtained from the profit and loss account. Let us see what is the revenues for NTPC for the financial year 2012. So, in 2012 the profit and loss statement indicates the revenues of NTPC were 64,830.65 crores. Now, let us see how much the revenues in 2012 has grown as compared to 2011. Revenues in 2011 turns out to be 57,407.30 crores. So, now the revenue growth in 2012 happens to be 12.93%. So, 12.93% is the yearly growth that the company has achieved in 2012. Growth ratios again can be looked at it from multiple perspectives. What we just now did was what is called as a year on year growth, that is, we compared the growth of revenues from 2011 to 2012. So, there is a growth in revenues over a year. So, this is your year on year growth. We also have something called as a quarter on quarter growth. A company actually has a financial year which can be divided into 4 quarters. Now, if you compare the growth in revenues of quarter 2 over quarter 1, that is called as a quarter on quarter growth. We are comparing the revenue growth from one quarter to the next. But at the same time, if we compare the growth in revenues in quarter 1 of 2012 as compared to quarter 1 of 2011, that is actually a year on year growth. That is, we are comparing the growth in revenues of quarter 1 of this year to the quarter 1 of the previous year. So, that is a year on year growth. We are looking at how the growth has changed this year vis-a-vis the revenues of last year. So, I hope now you are able to understand the difference between quarter on quarter growth and year on year growth. If you are able to compare between two subsequent quarters, then it is a quarter on quarter growth. On the other hand, if you are able to compare the growth of the same quarters in two successive years, it is your year on year growth. So, we can look at the growth ratios for any period that we are interested in. We can look at the yearly growth, we can look at the quarterly growth, we can look at the monthly growth. Whatever period that we are interested in, we can calculate the growth. So, the most common thing that we look at is your yearly growth or is your quarterly growth. The example that we talked about in NTPC is your yearly growth. Now, growth number per se might not actually give any meaning. After all, if you look at it, a growth rate of 12.93% does not really convey a lot. So, for us to really understand what is this growth all about, we will have to essentially do a comparison. So, a comparison could be in terms of the past. So, how much has a company grown in 2012 as compared to 2011? So, when we are doing that, we are trying to compare the past vis-a-vis the most recent growth rate. Another comparison could be to look at the company's peers in the industry. How much has the company grown vis-a-vis the peers in the industry? So, let us try and structure this analysis in a simple 2 by 2 matrix. So, let us look at a simple 2 by 2 matrix. So, on the one hand you have what is called as your past growth, and on the other hand we have what is called as your industry growth. Now, the growth rate that we have calculated can be either higher or lower as compared to the past growth or as compared to the industry growth. So, let us say that it is lower or it is higher. Similarly, lower on this scale and higher on this scale. And we divide this into 4 quadrants. Now, we can actually map the ratio that we have calculated into any of these 4 quadrants to derive meaningful interpretations. So, let us assume that the current growth rate is lower than the past growth rate and it is also lower than the industry growth rate. So, that means we are talking about a situation of quadrant 1. So, the company's current growth rate is lower than the previous year, so that means the company has not performed well. Now, this could be because of various reasons. It is possible that the industry itself might be going on a downtrend and this has also affected the company's performance. So, therefore, the company's growth rate is lower. But if you look at the growth rate is also lower than the industry growth rate. So, that means this is a problem that is very specific to the company of our interest. The industry is grown very high, but the company that we are interested in is not grown as much as the industry. So, therefore, it is a very bad indication of the company's performance. Company is not able to meet its own past performance, neither it is able to meet what the other competitors in the industry has achieved. Now, let us look at a situation where the current growth rate is lower, but it is higher than the industry growth rate. Okay, so, that means we are talking about the company being present in this quadrant. So what does it mean? The company's performance is lower than the past. It could be because the industry itself is going on a downturn, so therefore the company is also affected by this downtrend. But if you look at it, the company has actually posted a growth rate that is higher than the industry, which is a very positive thing. So that means the company is able to grow much faster than the industry because of its superior management, because of its superior ways of posting better performance as compared to all the others in the industry. Now let us look at a situation where the current growth rate is higher, but it is lower than the industry growth rate. So we are talking about being in this quadrant. So it is encouraging to see that the current growth rate is higher than the past, but in a way it is also a disappointment because the growth rate that the company has achieved is lower than the industry growth rate. The competitors in the industry, other comparable firms in the industry are growing much faster than the company that we are interested in, and why is the company not been able to at least meet the industry growth rate is something that needs to be investigated further. And then we have the fourth quadrant, where the company's current growth rate is higher and it is also growing at a rate that is higher than the industry growth rate. So this is the most ideal situation. The company is beating all the industry peers in terms of growth rate, and at the same time it is also posting superior performance as compared to its own past growth rates, and this would be the most desirable situation to be in for any company. So essentially when we are trying to do this analysis, an absolute number of 12.93% does not really make sense unless until we are able to compare it with some industry, compare it with its own past track record. Okay. Now let us look at other growth ratios that we normally use. So we talked about revenues. We can also do for profits, we can also look at for assets, we can also look at for equity. Any of the items that we see in the financial statement, whatever is of interest to us, we can calculate the growth rates and see how the company has performed for the given period. Next we look at another important indicator, which is your profitability. Profitability is a very important indicator for a business. In fact, people even go to the extent of saying that the very nature of the business to exist is to make profits. So if the business will have to be sustainable, if the business will have to be viable as a going concern, then it is very important that the firm is profitable. So how do we actually calculate the profitability? So profitability is nothing but a ratio of how much of profit the company is making, and we have broadly two types of profit ratios called as the profit margin ratios, and we have what is called as your rate of return ratios. Let us look at this one by one. Profit margin ratios. So if you look at a profit margin ratio, this uses the information available from the profit and loss statement. So you look at the profit and loss statement, you have two items here. We have revenues and then we have profit. So the profit margin is nothing but the ratio of profit after tax divided by revenues. So essentially this indicates for every rupee of sale, for every rupee of revenue that the company makes, how much of profit is the company able to make after taking into account all the expenditures, after taking into account the interest payments, after taking into account the tax and so on. So if you try and calculate the net profit margin for 2012 in the case of NTPC, it is 9223.73, which is your profit after tax, and then the revenues during the year were 64,830.65 crores. So this works out to a ratio of 14.23%. So during the year 2012 the net profit margin is 14.23%, but as I have been discussing earlier, this number of 14.23% does not really convey any meaning except to simply state that the company is profitable. Now if we have to really find out whether the profitability has improved or whether the profitability is in line with the industry standards, we have to do a process of comparison. So let us try and compare the net profit margin for 2011. So if you look at the net profit margin for 2011, it is 15.86%. So what does it indicate? It indicates that the profit margin in 2012 has come down by close to 1.5% as compared to what it was in 2011. So this immediately alerts us to why could this profitability declined in 2012 as compared to 2011. As far as an investor is concerned, the company is not actually making as much profit the company is not as profitable as what it was in 2011. For the company's management, this will help us to focus on those areas and help us to improve the profitability. The reduction could be due to various reasons. The reduction could be increasing costs, the reduction could be due to reduction in sale prices, whatever it is, but the trend of decline in profitability alerts us to the fact that we will have to understand the reasons behind this decline and rectify the situation so that the company bounces back to its original profitability. It is also important for us to understand whether the industry trend is also behaving in the same direction, that is the profit margin of the comparable industry firms also reduced in 2012 as compared to 2011. We look at another indicator of profit margin, which is your PBT margin. If you look at it, the company has profit before tax, and then the company pays a tax on the profit that it has made after payment of interest. Now this tax is dependent on various aspects. For example, if the company has a high amount of debt in the balance sheet, then it will also have a higher amount of interest payment, and if the interest payment is high, then the profit before tax will be lower and it will lead to a correspondingly low amount of tax payment. On the other hand, if the company is completely funded by equity, then there will not be any interest payment, and therefore the tax to be paid is going to be very high. So therefore, since tax is a subject that is managed by the company's financial managers, an useful indicator is to look at profit before tax as a percentage of revenues. So in the case of NTPC, the profit before tax margin works out to be 19.01% in 2012. The same indicator in 2011 is 20.98. So the trend that we saw in net profit margin is also evident in the case of profit before tax margin. Another indicator of profitability is rate of return ratios. So, in profitability ratio analysis, the profit margin analysis talks about revenues and profit after tax. So, both of these are taken from the profit and loss account, but in a rate of return ratio we are going to take one item from the profit and loss account and we are going to take one item from the balance sheet. So, rate of return could be on various aspects. So, we could have a rate of return on the total capital employed in the business, we could calculate rate of return on the shareholders funds. So, in any of this case we are going to take one item from the profit and loss statement, we are going to take one item from the balance sheet. Now, let us calculate rate of return on equity. Rate of return on equity is again a very common indicator used in financial analysis. For a shareholder, it is very important to calculate how much return that he is getting, how much return is the company able to generate on the shareholder funds that the company has on its balance sheet. So, return on equity is nothing but a ratio of profit after tax divided by total net worth. So, profit after tax is obtained from your profit and loss account and the total net worth is obtained from the balance sheet. So, if we calculate the return on equity for the year 2012, it is nothing but 9223.73 crores, which is a profit after tax, divided by 73291.17 crores, which is actually the total shareholders funds that we can see from the balance sheet. So, this gives a return on equity of 12.59%. Now, let us calculate the return on equity on 2011. Return on equity in 2011 is 13.41%. So, in essence, what we saw in the net profit margin ratio is also to a certain extent reflected in your return on equity ratio. The return on equity has reduced in 2012 as compared to what it was in 2011. Now, I will leave it to you as a short assignment to calculate other rate of return ratios. For example, you can calculate rate of return on capital employed and try and compare the numbers that you get with return on equity, try and compare it with the net profit margin ratio as well. Also try and kind of understand which of the ratios will be better, whether the return on equity will be higher or the return on total capital employed will be higher. Let us look at the next performance parameter, which is liquidity. What is liquidity? So, liquidity refers to the ability of the firm to meet its short term obligations, short run obligations. Obligations of the firm are generally classified as liabilities. The company has obtained capital from various sources and the company is obliged to give a return on the capital as well as return the capital to the investors. So, liquidity refers to the ability to pay or meet the short term obligations. So, where do we actually find information about the firm's short run obligations in the financial statements? So, we find it in the company's balance sheet, because the balance sheet is an indication of the company's liabilities as well as assets. So, short term liabilities, information about it could be obtained from the balance sheet. So, short term liabilities essentially are classified under the current liabilities, and when we want to calculate the liquidity, we use the short term assets, the current assets, and the short term liabilities, the current liabilities. An important liquidity ratio is called as the current ratio. Current ratio is defined as the current assets by current liabilities. So both the information is available in the balance sheet, and if we have to calculate the current ratio for 2012, it is nothing but 38912.52 divided by 17238.64. So this gives a number of 2.26. Current ratio for 2011 turns out to be 2.57. So again, if you look at it, the current ratio has decreased in 2012 as compared to 2011. So what does it indicate? What can we infer from this change? We could infer that the company's ability or the safety level that it can meet the current obligations in 2012 is lower as compared to what it was in 2011. Now, unlike profitability, where when we find that if the profitability reduces or if the rate of return reduces, then it is seen as a matter of concern, but in the case of a liquidity, a reduction in liquidity may not necessarily be a very bad thing. In sometimes a reduction in liquidity can also be seen as a way of efficiently managing the working capital requirements. So if the current ratio reduces from 2.57 to 2.26, it can be seen as a very efficient way of managing the company's working capital. There is no absolutely the basis that if the current ratio reduces, it is actually going to affect the company's ability to meet the short term obligations. On an average, it is expected that the current ratio will always have a number that is more than 1, because it is good prudent management practices that the level of current assets is always higher than the level of current liabilities, so that in the case of any unfortunate circumstances, the company can liquidate the current assets and then meet its short term obligations. But how much should the current ratio be more than 1? It is entirely dependent on the company's management style and preference. If the current ratio is substantially higher than 1, let us say for example if it is a ratio of 5, 6 or in those ranges, it is considered that the company has very conservative working capital management policy. The company is adequately prepared with a good amount of buffer to meet any short term liabilities that could arise. On the other hand, if the company has a current ratio that is only slightly more than 1, that indicates the company has a very aggressive working capital management policy. In case of any contingencies, the company is confident that it will be in a position to raise resources to meet any of the short term liabilities. So companies that are very confident of meeting the short term liabilities have a very aggressive or a ratio that is very close to 1. So what is the appropriate ratio is entirely dependent on the company's management style and the company's willingness to take short term risks. On an average, you will find most of the companies having a current ratio of around 3. So, if you are talking about a current ratio of 2.57 or 2.26, that is more or less in that range, and we could kind of say that the company is actually operating in a range that is considered to be safe and optimal. Another indicator of liquidity is what is called as your quick ratio. Quick ratio is a more conservative estimate of the company's liquidation ability. So, when we look at current assets consists of many items. It consists of accounts receivables, it consists of cash, it consists of inventory, it consists of certain loans and advances made to the employees, and so on and so forth. Now, liquidity ratio indicates that should there be an exigency, the company is able to quickly liquidate the current assets and then meet the obligations of the short term lenders. Now, the question is, are all the current assets easily liquefiable? Some assets may not be as liquid as the other. For example, cash is a current asset that is liquid. You can use cash for any purpose, but current assets such as accounts receivables or inventories may not be as liquid as cash. If the company has inventory, for it to meet the current liabilities, the inventory should be first liquefied and then it will have to be used to meet the obligations. If there are difficulties in liquidating the inventories, then we may not be effectively meet all your current term liabilities. So, to take that into consideration, that inventories might not be liquidated so easily, there is another indicator of liquidity, which is your quick ratio. Quick ratio is nothing but the ratio of quick assets to current liabilities. How do we calculate quick assets? We remove the inventories from the current assets, and that is called as your quick assets. So, quick assets divided by current liabilities gives you quick ratio. So, let us calculate the quick ratio of NTPC for 2012. So, the quick ratio is quick assets by current liabilities. Quick assets is nothing but 38912.52 crores, which is the total current assets. From that we subtract the inventories, which is 3702.85, and then we divide the amount that we obtained by the current liabilities. So, the quick ratio turns out to be a number 2.04. So, as you may note, because of the fact that we have removed inventories from the current assets, the quick ratio is a lower number as compared to the current ratio. The quick ratio for 2011 turns out to be 2.32. In organizations that do not have any inventory, the current ratio and quick ratio will have a similar value. Since quick ratio has a lower value when there is inventory, it is considered as a more conservative estimate of the organization's liquidity. So, from an analyst perspective, if you want to really look at under the worst circumstances what will be the liquidity position of the company, then a quick ratio will be a better indicator as compared to the current ratio. So, to sum up, we have looked at 3 parameters of performance in this lecture. We talked about growth, we talked about profitability, and in profitability we looked at 2 types of profitability ratios. We looked at the profit margin ratio and we looked at the rate of return ratio, and the third parameter that we looked at was liquidity, and in liquidity we looked at 2 types of ratios. We looked at the current ratio and we looked at the quick ratio. So the remaining parameters of performance we will try and discuss in the next lecture, but before we close, a quick thought question for you. When we calculate quick ratio, why do we exclude inventories from the current assets and not other items such as accounts receivables? So as we have seen, current assets contain, apart from cash, other items such as loans and advances, accounts receivables and inventories, and we excluded only inventories when we calculated the quick ratio, but we kept accounts receivables and other items in the current assets in doing the quick ratio. Why did we not exclude the accounts receivables? Should we also exclude the accounts receivables along with the inventory in calculating the quick ratio? So think about it, and we will discuss it in the next class.